Hi everyone. In today's video, we are going to be talking about sequence of return risk and how it play a key role to your overall financial plan. Let's get started. It is a very common concept that poor performance in early years of your retirement life can affect the longevity of assets, how long it will last. So we will illustrate this concept in detail in coming slides. So over over our investment life, we have experienced many different type of markets: rising market, bull markets, declining, bear markets, sideways, and flat markets. In the early year, the accumulation phase, the investor have the benefit of time to recover from the market volatility. If they stay invested and continue to invest in the long term, they benefit from this volatility as market eventually recovers and push investment values higher. As retiree enter the distribution phase, when they start taking money out of their investment, the challenge is that they are drawing from their pool of investment, potentially locking in losses to their portfolio. Wherever the accumulation investor recovers fully and buy more investment in a correction phase, the investor in a retirement has reduced their portfolio and does not recover to the some same extent. So if you this strategy used to this strategy the strategy is used to demonstrate income in retirement by many is in our industry are often oversimplified. The chart is an example of that type of simplified illustration. It assumes that investment earn a return of 5% each year. Investors start retirement at age 65, draw 7.2% per year, $600 per month in our example, and runs out of money at age 89. This seems like a logical, realistic example, but by assuming a consistent return is achieved each year, it ignores the reality that the portfolio might earn 5% on average, will be subject to year fluctuation in return that could negatively impact your income plans. In fact, in any planning assumption that is used to just that an assumption, it is not a guaranteed, and chances are the actual return of the portfolio will be either higher or lower. Let's look at some examples that reinforce this concept further. To illustrate the effect of market volatility, we can have on the success of your plan that what the market volatility can have effects on your retirement plan success. Let's consider a hypothetical situation. Let's assume that over 3 years the return was 25% one year, minus negative 115 1 year, plus 5 1 year. So in those 3 years the average return is 5%. These are somewhat extreme numbers. We would not expect this type of volatility from a portfolio designed for someone in retirement, but it helps to show the effect of the sequence of returns. In the clockwise example, the negative year minus 15 happened in year 2, relatively early for the retiree that is drawing income, while the best year 25 does not happen until year 3. After the worst year in in our example. On the challenges in the planning for the retiree, we never know what the future returns for the market will be. We know the market can be quite volatile sometimes, but we never know when the volatility will occur. So um, if we revisit the example that we showed you earlier, an investor drawing 7.2% per year and applying the return from the clockwise scenario, we can see the impact that has on the our simplified illustration. Even though the retiree continue to draw 7.2, average return continue to be 5%, the impact of the portfolio suffering from most negative year early on results in a scenario running out of the money at age 83. So sequence reduced the total income drawing year from 89 to 83. A dramatic 6 year reduction is in drawing income with the same average return. So this is a very uh, detailed example that okay, that the same return client achieves, the same draw was made, but how the return was delivered decreased 6 years of uh, income from the portfolio. This example demonstrates the retirement risk known as sequence of return risk, and or the impact of income planning using an average rate of return, but not accounting for the sequence or order the annual returns that will make up that average. Now, to what if we were consider a counterclockwise example? As again, if we go back to our earlier example, the average over the 3 year period is 5%. Due to the change in timing, the worst year of return have minus 15 happen in year 3. Still, the average over the 3 year period remains the same 5%. So if we use this example using the same simplified scenario that we referenced previously, average return of 5%, 7.2% payout, this investor depleted their retirement pool by age 87. This is better than clockwise sequence of return depleted at age 83, but it does not measure up to the original illustration that we presented using the simple 5% average. Even though the negative year happened later in the example, the impact is slightly less than the previous example, but the sequence of return results in this investor running out of money 2 years earlier than the original 89-year estimate. So if the same 5% money is average return is earned, how those returns were delivered, that if the negative year occurred earlier, the money was running out age 83. If the negative year return ran a little bit later, the money lasted till 87. So what we can figure it out that okay, the sequence how the return is delivered in your portfolio has a huge impact. So, Fidelity Investment and a well known global money manager created this illustration. The performance reflect a diversified portfolio with 50% in equities, 35% in bond, 15% short term investment. They portray a long term consistent investment average of 5.9 and 2.25 level of inflation. As you can see from the example, the investor drawing 5% a year inflation adjusted would have even income well in retirement. In fact, in this example shown, they do not run out of funds till age 100. Now, recall how we demonstrated earlier the risk when using long term averages and sequence of return risk. This chart uses a mathematical testing method referred as a Monte Carlo analysis to show the range of possible outcomes. Considering the expected return of the portfolio and expected variability of return of the portfolio, rather than relying only on average return to better account for sequence of return risk. So it you can see with the variability of return, the outcomes are numerous. So IG Wealth Management, we use a leading software that stress tests your probability that your income expectation will be met using thousands of permutation to potential future risk return. Now, if the also, no one in the industry can predict future market returns, how those will impact your retirement. By using this advanced approach, provide us our retirement investor with much more confidence and about retirement planning and probability of achieving their future income expectation. So that's it for today's video. I know it's a little bit a long video because the sequence of return is a little bit a complicated concept to explain. If you enjoy watching and have any friends and colleagues and family member that might find this value in this video, please feel free to forward this on. Also, if you have any questions and comments on this topic, and if I can be a further help to you, please do not hesitate to contact me. Thank you very much. We will see you next time.